Good afternoon, everyone. Nick Martin is my name from BDO, and together with my colleagues Duncan Clubb and Sean McKinnon, we're going to have a discussion this afternoon around what are the risks for advisors as we emerge from COVID and into this new normal, whatever this new normal might look like. A couple of housekeeping issues. We're going to run some polls during the course of the webinar, which will create some interesting conversations, we hope. We're going to provide you with the slides at the end and also ask you to contribute to a survey. It's inevitable that we won't get through everything, we accept that, but if you feel the need afterwards to ring Duncan, Sean or me or flick us an email, please do so. Details if required. So by way of background, everyone knows about COVID, but I think what's become really interesting in the last couple of weeks in particular, there's this recognition that as we move towards September and out the other side, there's going to be an increase in the level of stress. Peter Costello was on 7:30 Report last night talking to some of these issues. So we thought we'd have a think about and talk to, there's some wonderful opportunities out there for the astute business operators, opportunities to grow their business. And obviously at the other end of the spectrum, there are businesses which will struggle. They're going to have some challenges. They're going to become exposed. And in amongst all of this, the role of the advisor, accountant in particular, solicitors to a lesser degree, but we're going to be under a greater deal of pressure, greater level of pressure to ensure that we're addressing these sorts of issues and what the new normal looks like. We thought to start the session, we'd pose a couple of questions which are on the screen now to understand the extent to which clients have turned their minds to what this restart looks like. So we'll give you a moment to complete the poll, which is on the screen, and then we'll post the answers and we'll talk to them. We'll give you a moment to complete it. So, thank you for that, and let's see if we get IT to work and put the results up on the screen. Okay, we're looking for the web poll. Not sure what's happened there, but we might have to come back to that. So we thought those questions we hope will get people thinking about the sorts of mindset that needs to be adopted as we move through this period of identifying the issues, reacting, and then building our resilience and ultimately developing a stronger business as we emerge out of COVID. So we think that this graphic provides sort of a nice, neat visual. We can't really look to the future without reflecting upon what's happened over the last few months, and we thought it was worth reflecting upon the lessons of lockdown. We all heard the expression that cash is king. It's not a new concept, but it's interesting that those businesses that are in good shape today, relatively speaking, are those businesses which turned their minds early to whether they should push on, bow out gracefully, or adopt this hibernation strategy. And interestingly, in amongst all of that, these are the businesses which were particularly disciplined in and around their cash management and developing a new set of criteria to assess issues and ultimately make informed decisions. At the other end of the spectrum, there's a number of businesses which really adopted as many concessions as they could, but didn't adequately turn their minds to what happens once September 20 comes around. And so with all of that, it's really encouraged, forced, compelled businesses to think far more closely and examine in a far more detailed way their working capital and the various components of it, whether it's the forecasting. And Duncan, Sean and I have been saying for the last 3 months, get the architecture right of your cash flow. Too many concepts get lost and mixed within cash flow forecast. Get the architecture right. How do we manage it? How do we micromanage it? Are we thinking about the right things? And how do we assess the quality of our cash flow? We all know about the various concessions and moratoriums. Are they a necessity? Are they a bonus? What happens when they come to an end? And that's going to come around reasonably quickly. In parallel, we've seen a number of businesses that have, a number of leadership teams more accurately, that have really focused on how they're going to enhance their business. Don't waste the crisis, as Winston Churchill said. They've thought about things like, are we in the right markets? Should we be looking elsewhere? Do we have the right relationships? How do we enhance our systems? Credit is going to become a bigger issue on the other side, and working capital we've touched on. So what are the issues that businesses need to think about and do something positive with to ensure they're in the best position possible as they emerge over the next 3 months, 6 months and 12 months? Most businesses have a good month when revenue's up, but how many businesses genuinely consider, how many of them genuinely critically review what customers look like, what's a good customer, what's a poor customer, the customers that if you had your time again, you wouldn't have on your book? The number of businesses that are thinking about the supply chain, and it's not just our supply chain, but it's also about understanding how our key stakeholders, suppliers in particular, how they fit within their supply chain and how this period is impacting them. To what extent have we thought about the inefficiencies within our businesses, whether it's our own accounting practices or whether it's the clients for whom we act? And we'd all admit that most businesses carry fat. To what extent can we address that, use this as an opportunity to sharpen up our business model, to get us into better shape for the other side? And so when we get to this third slide, which is the final slide on the reflections of lockdown, what are the sorts of things we need to be thinking about as we look to restart or rebuild or reboot our business, or to help our clients restart, reboot or rebuild? And Duncan and Sean are going to talk shortly to a number of these issues in a bit more detail. But what's particularly interesting, I think, is there's a number of businesses which have accrued liabilities over the last 3 months. We'll likely continue to accrue them for the next 3 months until the end of September. But then we have to deal with them in some way, shape or form. And so how do we manage our working capital? What's our plan? What are the conversations we're going to have with our key stakeholders, like landlord, like bank, like our key suppliers, like our workforce? Do we understand the difference between those suppliers who are critical and those for whom we can find alternatives? So I think the big message here is to ensure that we are doing everything we can possible to retain our clients. We don't want to lose clients, but now's the time when we need to be thinking about, are we providing a complete solution to our clients? Before we get into Sean and Duncan's detailed commentary in and around some of our key stakeholders, there's some questions on the screen comprising a couple of polls. Let's hope we get the IT to work. But we're interested to hear or learn the responses to these two questions, particularly how businesses are going to respond. So we'll give you a moment just to reflect on it and complete that poll. We'll leave that with you for a moment. All right. a bit of luck, we'll get some results, and if we don't, again, apologies. I'm a very good accountant, but I'm not very good at IT.
So Nick, the results have come up here for me, mate. I might talk to them if that's okay.
Oh, why don't you talk? That'd be good, Sean. Thank you.
So look, the first question there, what percentage of your clients have used lockdown to make material change to their business? Interestingly enough, it's 33% less than 10%, and 28 and 28% for 10 to 25 or 25 to 50. So I think what we can tell out of that is that there hasn't been a significant amount of activity around changing business, and that people have really been dealing with surviving during this period rather than necessarily looking for towards the future, which we're now hopefully moving towards. So we might try the second question. Should be an interesting result. So if we'll just give you a couple of minutes to go through this to answer this question. So look, that's a pretty positive result, obviously. Greater than 50% of your clients is the number one answer there in terms of how many are going to come back by 31 December. But look, equally important to note, I guess, is that by the look of this, at least half of the respondents have indicated that less than 50% of clients will be back to full capacity by 31 December. So as we move into this next section where we talk about the impacts of key stakeholders, I think that just means that what we're going to talk about will be fairly important in the context of those businesses in particular that won't be back to 100% by the end of the year.
So with that in mind, we wanted to spend some time thinking about what happens between now and September, but also how does September shape what happens thereafter? We know that there's a number of concessions, there's a number of moratoriums which have been introduced by the federal government around landlords, banks, JobKeeper and the like, and we'll hear from Sean and Duncan in a moment. But I'd encourage those on the session to turn their mind to what are the financial impacts of these issues, whether it's on a company, whether it's on the directors who provided guarantees, whether it's in and around how we're going to deal with deferrals, and the overarching what if. There's obviously a level of enthusiasm for JobKeeper to be extended. What if it does? What if it doesn't? And so with that in mind, we're going to ask one more question before Duncan and Sean take the reins. What percentage of your clients are likely to seek additional support after JobKeeper expires? I think this will be interesting.
So Duncan and Nick, if I can see the answers here, so I might just quickly go through them. So what percentage of your clients are likely to seek subsequent support? The number one answer there is 25 to 50% of clients, which was 41% of respondents. So look, I think what we're telling from all of these poll questions today is clearly that while we are seeing a really significant return and a significant amount of businesses are getting back to work quickly, that there's also going to be a material amount of those businesses that are going to need some additional support past this September period when a lot of these support measures currently are anticipated to expire. So with that, Duncan, I might flick to you for this next section.
Right, thank you, Sean. Thanks, Nick. It's Duncan Cobb from the Sydney office here. I just for a little additional context as to why I was keen to be involved in this presentation today. Since COVID sort of kicked off in March, our team in Sydney here has been involved in about a dozen, touch over a dozen independent business reviews, where where we've gone in on behalf of various stakeholders to do a real deep dive into the various businesses. And those businesses have been spread across a wide range of industries and geographies. And as I said, we've been doing it for a whole bunch of different stakeholders. And the overwhelming theme was that come September, everybody, they universally all had a problem around cash. Some of them we don't think are going to be able to start again. Some of them will be able to start again and it will be fine. Some of them will be able to start again and it's probably not worth it, to be honest. They're going to be working for a long time to work through the issues that they've accumulated in the last 6 months for no real personal benefit. So that's why I was keen to get involved in today's session. On the subject of stakeholders, landlords are obviously a big one. And particularly on the sectors that have been hardest hit by this virus, so hospitality, retail, and obviously commercial office tenancies. Now, in our feedback with the landlords, they're obviously acknowledging that they're part of the problem, part of the solution. I guess the key message here is that they're not prepared to be the whole solution. So, in terms of the longer-term relationship with your landlord, early engagement obviously key. They've had a massive capacity issue in terms of dealing with the huge volume of requests that they've been getting. But they're obviously quite pragmatic. That the world has changed. It's a fundamental shift, and that they are going to have to be on board as part of the solution. They need tenants going forwards, so there's no point in being too obstinate about it. But in this immediate sort of period, they've had no choice. There's been the code of conduct, which has been mandatory. They've had no choice. But come the end of September, that cliff that we've all been talking about, the shoe is back on the other foot, and the power balance changes again because the landlord can start asking for things and start acting in accordance with the lease. So we're going to have to get on top of our landlords and negotiate with them about what the future of our businesses look like. So yeah, it's a shift in power. I mean, landlords have traditionally held all the power. COVID has really upset that. I think in the near term, they're going to get a lot of the bargaining power back because of those, expiration of the moratorium. But longer term, it's really going to be a case-by-case basis as to how your business fits within the sort of tenancy portfolio that each landlord has. So that's really all I've got to say on the landlord space. So Sean, do you want to deal with the next stakeholder?
Sure, Duncan. So the next stakeholder that we wanted to talk about was obviously banks and financiers, as you can see up there on the screen. So as we move forward to September, there have been a lot of banks and financiers that have offered material support to their customers on the back of COVID-19. And you would have seen as soon as COVID-19 really took hold in March, the Banking Association and all their members indicated that they would provide up to 6 months worth of support in the form of both capital and interest deferrals. And generally these are scheduled to end in September of this year. What we saw with that first wave of support was that banks were very keen to help, and they didn't actually do any due diligence at all. So literally, if your customer rang the bank and requested some sort of assistance, whether that be a deferral or a part repayment, then they were generally met with a positive response without any request for due diligence. Most of the time that was delivered from the banking relationship manager that's been the relationship manager for that file forever. And there was, as I said, very little due diligence. Now, what we're going to see in September, we expect, and look, the poll questions that we ran just before were really quite informative around this and only support what we've been thinking, which is that come September, there are going to be a lot of businesses that are not in a position to just start repaying that capital and interest that was deferred. They may not be able to go back onto their old repayment straight away either. They may even need additional working capital support to actually manage through the restart. And if you think about some of the pubs and clubs that we've been talking to in particular, they're going to need to find some working capital just to be able to restock and get the business running again. And when JobKeeper runs off in particular, there's going to be, and landlords start expecting you to pay your full rent again, all these things happening at that point in time mean that one of the key stakeholders and most likely to be able to give you help going forward will be the banks. But those banks are going to look at it a little bit differently than they did in March. What we think is going to happen if there's a second wave of bank support required is that there's going to be a new level or a certain level of due diligence that banks will request of your customers in order to be able to provide additional support. Now, that due diligence will typically be the provision of financial information. They may even look at getting an independent business review conducted, which I'll talk about a little bit more in a minute. We think that the period that we've just gone through and that which we'll be going through till September, where covenants and breaches of covenants or breaches of short-term limits, overdrafts, etc., have been largely ignored, that will stop. And those sort of things will need to be managed really carefully with your bank, as in you'll need to be transparent that they're coming, you'll need to be on the front foot, you'll need to be managing that situation with your bank. We're already seeing pricing and fee increases that banks are starting to provide to our customers, and we expect that that's going to be something that we see across the board, especially in circumstances where you're asking for new facilities to be renegotiated. And we just like to put on your radar that in this context of some of these new bank support measures that may be sought post-September, whether that be increased facilities, whether that be renegotiated covenants, etc., you need to keep in mind the loan-to-value ratio impacts of those, because what we are potentially seeing also is a scenario where you may be increasing your exposure to the bank at the same time that some of your landed security, so residential property in particular, may in fact be decreasing slightly. Now, what we're hearing from the banks is that they're gearing up their workout teams to deal with the expected level of financial stress. But I think it's also important to keep in mind that the banks have just gone through a really difficult period with the Banking Royal Commission and everything that led up to that. And the consequence is that banks are very loath to go down the process of being too heavy-handed with their customers. And they certainly don't want to be able to be imposing things on them, such as independent business reviews, and certainly not receiverships if they can avoid it. So there's an opportunity for you as advisors to be able to step into that breach and solve some of the bank's problems for them by providing them with early, transparent financial information, engaging with them and working with them cooperatively and your customer to be able to move forward. Now, a few things that we just wanted to highlight here that may lead to further scrutiny or a transfer to bad bank. So the soft triggers that we've listed there are things that are probably going to get the bank's attention: late reporting, obviously key litigation, if they start to see covenant breaches, inability to produce produce a forecast, or surprises. Nothing banks hate more than surprises, such as requests for overdraft extensions on short notice. Hard triggers, things that will have a very high likelihood that you'll move to bad bank, if they're on notice of the fact that you're in an ATO payment arrangement or installments and those are behind. If you've missed repayments, obviously, if your superannuation payments are behind, or if your loan matures and you're not in a position to be able to renegotiate a position that's suitable to the bank, etc. Now, I just wanted to talk briefly about what happens if your client is transferred to bad bank. So the first thing I wanted to say is that's not necessarily a terrible thing. We're going to see a lot of businesses that go through this next period that do need a little bit of help to get through. There'll be good businesses that, as long as they're supported the right way, will be able to get through what hopefully will be a temporary funding hole. And as trading conditions hopefully return to normal and as the economy comes out of a recession, those businesses will hopefully move forward positively into the future. Now, if you go into bad bank in that period, the managers that work in that section typically have a lot more power than your relationship managers at the moment do. And when I say power, I mean the ability to provide additional funding or the ability to alter things like covenants and limits of overdrafts in a short time frame, or without having to go through a credit department. What they will expect to see though is understanding what your sustainable level of debt is. They'll require some timely and quality reporting that almost always looks like having three-way forecasts. And as I said earlier, they don't want any surprises. Now, an IBR, which we've got on there, the last point, which is an independent business review, is something that may be requested. This is when a bank, where your file's been transferred to what's known as bad bank, decides they need more information on the borrower, and they will typically identify an independent accountant on their panel and ask that person to do a business review. Now that may cost $30,000 to $50,000, maybe more or less. As advisors, that's something that you might be able to cut off. And when I say cut off, banks don't like to impose that on their borrowers if they don't have to, but they need the information. And you as advisors are typically those with the most information on your clients. So it's an opportunity for you to engage with those banks and transparently understand what information they need and offer to provide that type of information in those report formats for them, which allows you to help take control some of the influence of that process, and certainly removes the prospect that you could lose influence if an external accountant comes in who may then have a greater control over outcomes than you. So Duncan, I might leave to you to talk to the next slide.
Just before we do, I should just interrupt, sorry. If anyone's got questions on the way through here, please use the chat box and we will respond to them in real time. And that's my mistake for not offering that at the start. So fire away any questions. Sorry, Nathan.
All right. Well, I've got a question. Sean, obviously pre-COVID, there was a heap of liquidity floating around in the financial markets, coupled with low interest rates, which made refinancing pretty easy. Do you think that's going to change in the post-COVID world?
I do. Look, I think that the refinancing market is definitely going to be impacted as we move forward. Banks are going to be dealing with issues within their own client bases, and I think we're going to see new to bank lends will be a little bit more difficult to obtain. They're not going to be impossible, but I think you'll see greater scrutiny, and I think you will see a little bit more difficulty in getting those across the line.
All right. Thanks, mate. I agree with you. Now, in terms of the next key stakeholder being the federal government, obviously they've been providing a massive amount of stimulus to the economy over the course of the last 3 months, and they've done a brilliant job. They've really hit the mark. They've solved a lot of problems in the near term. Certainly, from an insolvency practitioner's perspective, we were all flat out for the first 3 weeks of the virus and the shutdown, as businesses were panicking around what they should do and where they should go and how they're going to get through this. And then that sort of 3-week frantic activity all just came to an immediate halt once the government started announcing their stimulus measures. So I cannot applaud the government more for what they've done to keep the economy ticking over. But obviously, as we've alluded to, this all ends in September. And I guess a big driver for insolvency has traditionally been the ATO. They've done nothing for the past 3 months, and I can't see them really being that proactive going forwards, provided you engage with them and deal with them, act in good faith. But what will, I think, drive insolvency come September is the end of the 6-month moratorium on insolvent trading, and also the stat demand changes, also in September, around the 6-month period for a stat demand to be satisfied. Anecdotally, all of the lawyers that we talk to are sitting on a big pile of demands that they're ready to issue as soon as the short-term measures end, and it goes back to 21 days. So we're expecting that to be a driver of insolvency. And unless that changes in September, your clients will be receiving demands for payment to suppliers and creditors, and there's not much that can be done about that at that point. So it comes back to the point of you need to focus and work on your cash flow to make sure that when this assistant measures come off, that you're prepared to deal with what will be some fairly immediate short-term cash requirements. Now we're going to move to another poll here around the issue of tax arrears and whether or not your clients were in ATO payment arrangements prior to COVID-19. So just have a few seconds for everyone to have a look at this question, and then I'll pass it back to you, Sean. Okay, I can't see the voting page come up yet.
That's right. I've just got to note that the polling's not working, but I think irrespective of that, it's worth reflecting on the number of clients within your portfolio that do have this exposure risk to the ATO, in particular the repayment arrangements. And Sean, I think you're going to take a deeper dive into this very issue now.
I will. So look, the other key stakeholder obviously is the ATO, and then some of the state taxations, which have all offered a lot of support to customers and businesses in this last COVID-19 impacted period. That support has largely been in the form of deferred payments. And it might be that some of your clients have actually entered into instalment negotiations. The first thing I wanted to touch on though was the importance of lodging all of your relevant ATO lodgements. Now, during this period, we've obviously had the moratorium on insolvent trading, which Duncan just referred to, effectively a safe harbour moratorium, but that ends in September. Now, so in that period, it didn't really matter if you made your lodgements, you'll still got the benefit of the government moratorium. However, there is in fact a safe harbour legislation which was brought in 2017. The purpose of that safe harbour legislation was to provide directors with protection from insolvent trading liability in circumstances where, if they suspected insolvency, that they entered into a formal restructuring plan that's likely to have a better outcome than going to insolvency. They get an external advisor to sign off on that as being more likely to achieve the outcome as desired, and then they're in safe harbour. Now, if you are a business that is going to have some level of insolvency risk and you're trying to work through a recovery, a restructuring plan on the back end of September, once that government moratorium ends, all of a sudden, you would then need to rely on the traditional safe harbour or the normal safe harbour guidelines, and they require that all lodgements with the ATO have to be up to date. So that's an important thing to keep managing if you need to require that assistance past September. The other thing I wanted to talk about was instalment negotiations. Now, if you're in the process at the moment of dealing for some of your clients and getting repayment plans with the ATO, it's important to think about the personal liability that may attach to those. Now, we're all probably quite aware of the director personal liability that is attached to director penalty notices. Now, these instalment negotiations obviously don't impact that, but what they can potentially impact and what people often miss is the fact that if you enter into an instalment negotiation or a repayment plan with the ATO, and if your business then later becomes insolvent and goes into liquidation, depending on how you entered into that instalment negotiation and how you entered into that repayment plan, there is a prospect that a liquidator could claim back some of those payments as a preference payment. And if a liquidator claims them back as a preference payment, the directors then become personally liable for those payments back to the ATO, very separate from the DPNs. So the question that you should be looking at and making sure that your clients are looking closely at when they enter these positions is that they are properly basing their instalment arrangement requests on realistic new world cash flows, that they can demonstrate that the business is still solvent and that they've got a reasonable expectation of that. And once you do that, you should have a much better opportunity to be able to demonstrate that the business was hopefully solvent during that period and less likely to be something that could be clawed back. So Duncan, I think we might roll on to the next one with you now, please.
Okay, thanks, mate. Suppliers. Obviously a key supplier, a stakeholder for most businesses. COVID's really, it's really changed the supplier-customer relationship. You know, pre-virus world, payment terms, 30 days, 60 days, whatever it was, subject to a contract and away you went. The virus changed that because of the, I guess, the measures that were implemented by the government in terms of, you know, 6 months for a stat moratorium and basically a safe harbour for insolvent trading. Once the supplier had provided goods or services, there was really nothing that they could do to get their money and accelerate payment of their money in the near term. So it caused a lot of suppliers to really reassess their trading relationship, their trading terms, and it's basically sort of shifted the relationship fairly fundamentally. It's less contractual and it's almost more transactional. So we're seeing suppliers drop their terms from 30 days from month end to 7 days or 14 days or cash on delivery, depending on their individual business circumstances. And it's really going to be interesting in terms of how businesses, once they look to reopen and ramp up to a normal or historical level of volume, how those relationships with the suppliers are affected and what that impact is on cash flow. Because I certainly wouldn't be expecting to get 2 months terms in a huge number of sectors, particularly retail, post-COVID. The suppliers that I'm talking to are at 7 days or COD because they need to look to their own position and protect their own cash flow. They're starting to act more like banks, to be honest. They're looking to take security positions, they're looking to take personal guarantees, they're looking to understand the financial viability of those that they're supplying, and it's just really shifted the dynamic. You will have seen last week, for example, that QBE has stopped paying trade insurance to Meyer and David Jones. That's a fairly telling indicator as to the attitude of the insurers to sort of some of the major players in the retail sector. So certainly, if you're looking to supply David Jones or Meyer, for example, you really have to consider the nature of your relationship with those customers. So that's, I guess, been a big shift, and it's only going to happen more. And I guess from a client perspective, you just need to understand the strength of your relationship with your key clients and what that relationship is going to look like as the new normal going forwards, because you can pretty much guarantee it will be very different to what it was for a comparable period last year.
So I might talk briefly then about another key stakeholder, obviously, which is your workforce, your employees. Now, we've talked at length about the fact that restrictions are starting to ease, and we're seeing businesses starting to move back into some increased level of trading. And that will bring with it, obviously, a change requirement around your staffing. And at the same time, as we move towards September, again, we've talked about this a lot, but it's important, JobKeeper will come to an end. And when JobKeeper comes to an end, and when trading requirements move forward, and you start to require additional staff, there's obviously going to be a bit of a cash squeeze in there. So what we're suggesting, and I'm sure that you're already across this, but it's important to reiterate, is that it's really critical to start looking at those staffing levels in advance of September, understanding what you can afford, and then understanding once you've worked out what your cash flow can actually deal with, or what cash flow can actually support in terms of staffing, think about the options for those excess staff that you're just not going to be able to keep actively engaged. Now, a lot of businesses during COVID have taken advantage of the stand down process, and some have gone down the route of redundancies. There are differing financial impacts and cash flow impacts for both of those, and it's important to understand exactly what they are and whether or not you can afford it. In circumstances where it's required, or where it might actually make sense, you should be looking at restructuring options as well. The use of things like a voluntary administration, or potentially even liquidation if there is an opportunity to potentially restructure a business that sees some of the employees continue but some maybe not. And that's where things like the Fair Entitlement Guarantee, the government scheme which provides for the payment of employee entitlements where they're not able to be funded by the business, can actually potentially be of use. We'll jump onto the next slide. I just wanted to cover off briefly before we move on to talk about the fact that, look, on a positive side, we've seen this great change in the way people have delivered their work over the last 3 months. And it's all been around flexibility, agility, and working from home. We've seen that has created a few problems in different places, but it's largely gone pretty well. But coming out of this, one of the things that I think is going to be important is to understand the IT system requirements that allow you to actually improve the way that we actually work flexibly or working from home. And things like requiring office space and whether or not there's potentially some savings in there for customers, I think is something that is definitely something that we could be talking about as well as we move forward. In short, I think we don't want to miss the opportunity that there's presented from COVID-19 around flexible work opportunities. Because there are both some productivity gains that can make, and there are also some physical savings that we've seen that can be employed when you're not actually when you're not transporting people around and you're using technology to connect people. So look, I think that sort of covers off what I want to cover there. The main risk, I guess, that we're looking at in there for you as advisors, though, is when you're dealing with the workforce, certainly encourage your clients to be proactive, but don't overstep. And what I mean by that is, there's some fairly specific legislative and regulatory guidelines and requirements when you're dealing with employees, especially if it's related around to stand downs and that nature. So I would encourage you to make sure that you engage the right external professionals, such as workplace lawyers, employment lawyers, essentially where that's relevant. So we might now, that sort of brings to an end the section what we're going to talk about here around key stakeholders. And I'm going to flick across to Nick now, who's going to take a deeper dive into the risks for advisors that we see in the new world that we've sort of touched on in this stakeholder section already.
Thanks, Sean. So there's a few things that if we have time, we'll aim to get through, but I think that the priority issues now, as we look at our clients and understand their own exposures and risks during this extraordinary time and also the restart, how do we ensure that we've got the right structure in place for our clients? And the traditional model was one of the asset holding entity and the operating entity. And as the visual in front of us shows, you would typically set up the asset owner with the $1 million piece of plant, and OpCo would employ staff. It would use the plant, it would raise invoices, it would incur supply obligations, it would probably be the tenant of the factory. But what would happen at 30 June each year? There would be either a journal entry between OpCo and AssetCo. There might be management fees charged, but it would typically be driven by taxation type implications. The reality today, though, is OpCo is likely to be under more stress today than it was 6 months ago. And so if Duncan Clubb were to be appointed the administrator of OpCo, the first thing that he does as the administrator is a PPS search to understand what security interests are registered against OpCo and AssetCo for that matter. And so whilst OpCo is in possession of AssetCo's plant, and while AssetCo clearly holds the asset, Duncan is probably going to take possession of the AssetCo's asset, being the $1 million machine, and convert it to cash for the benefit of OpCo's creditors. Now, this is obviously a particular concern given that we've designed an asset protection strategy predicated upon separating out the asset from the liability companies. The key message here, if you have an AssetCo OpCo structure, ensure there's a written agreement, ensure that there's a security interest that is enforceable, and ensure that that document being written, verbal doesn't cut it, make sure that that document is registered on the PPS register. It's a really important component of asset structuring, and it's only now in these difficult times that these asset structuring strategies are exposed. Alongside that, we'd expect that there'd be a number of related parties that will be helping fund OpCo during this rebuild phase, whether it's because they need to fund redundancies, it might be because their limits are full at the bank, whatever the reason. I'd be encouraging you to ensure that the related party that makes an advance to OpCo adopts the same approach with the PPS. Documented, written agreement, security interest, and registered on the PPS register. The next one that we want to touch on is a matter that's very dear to all of our collective hearts, and that is the ATO. Again, the ATO sustains a number of businesses. We know about these three critical tools, but the particular issues that I want to highlight here, many accountants act as the registered office of their clients. So if we expect there's going to be an increased level of stress, an increased focus on recovering of delinquent debts by the tax office or other creditors for that matter, please ensure that you've got the right internal processes at your office to ensure that statutory demands, if served on your office as the company's registered office, are dealt with. The greatest concern that we'd have is that the registered office is served, but it doesn't make its way through to the company to be actioned. And of course, once that statutory demand has expired, there's no road back. So a really important issue. Again, following that theme of many accountants playing the role of sort of corporate secretarial support for their director clients, director penalty notices, which Sean touched on a little earlier, director penalty notices are deemed to have been served on the residential address recorded in the ASIC database. So again, I would encourage you in these unusual times to ensure that your secretarial files are up to date. If a director has moved address, he or she is deemed to have been served if the address is per the ASIC database. So just make sure that we've got our internal systems and processes right for dealing with this at this time. Sean touched a little bit earlier on this unfair preference issue. And here's a pretty typical example of what we see, which is where the director borrows $500,000 or could be $50,000 to fund an ATO arrears. Now, the director will typically draw that down under the company's overdraft, which is inevitably secured by the bank's mortgage over the family home. If the company subsequently fails, the ATO is required to pay $500,000 to the liquidator as an unfair preference. At that point, the director becomes personally liable to reinstate the tax office for the money which the ATO had to disgorge to the liquidator. And that's a Corporations Act issue, not a Taxation Act issue. So steps 4 and 5, it's cost the director $1 million for this, and yet they've received no benefit for it. The company's in liquidation, and the director's either has drawn down and has had to repay the tax office. So the really important issue here in these potentially stressful times is at the bottom of that slide there. Please, please, please advise your clients of their personal liability risks in entering into these instalment arrangements with the tax office. When you decide to negotiate, or when you agree to negotiate on behalf of the director client with the ATO, obtain written instructions and ideally obtain acknowledgement from the client of their residual liability risk at a personal level. The last thing we want is for our profession to be challenged by incomplete or incorrect advice. So assisting a client that we've had a 10 or 20, 30-year relationship with is one thing, but we need to manage our own risk during these extraordinary times. So just please take that on board. Annual returns. Again, if we're playing the role of corporate secretarial, we will be sending out on a monthly basis, or perhaps more regularly, annual returns to our director/company clients. And implicit in that is that the director, upon signing the annual return, is deemed to have signed a solvency resolution. Now, 12 months ago to today, things have changed somewhat. So when you send out your letter to your clients saying, please sign and return to this office, I'd be encouraging you to think about adding some words which at least flag that the director must think about some objective criteria, that the director thinks about the new world, because to sign a declaration of solvency obviously requires the director to think about his or her company in the current environment. And so the environment today is very different from where we were 3, 4, 5, 6 months ago. So what's the criteria which you're going to use to help your director form that view? P&L, balance sheet aren't the answers, and certainly not 30 June or 31 December. So we need to think about how do we help our clients make informed decisions, because we don't want to be accused of simply saying to our directors, sign the attached and return it. As an accountant, you're probably far more aware of what's going on within your client's business, but do you see it for the context? And this is a really simple table which shows a trend which emerges. And whilst you are all over what an ATO arrangement and trading losses and 90-day creditors looks like, it's not until you build a picture like this that you start to see that the accountant or the director ought to be picking up the phone and having a conversation with the other, perhaps as early back as November or December, but certainly by the time you've got through Christmas trading in February or March. And yet the company continued to trade until the end of June, at which point the directors appointed administrators, by which time it was too late. So just encouraging you to think about the context of the knowledge that you're in possession of from your clients. And this obviously shows a really basic, with the evidence of insolvency, we've got to do everything we can to curtail the enthusiasm of our clients to continue to incur further debt and expose themselves to personal liability. think we'd all agree that there's going to be some changes in a number of businesses over the next 3 or 6 months, 12 months. So I'd pose the question to advisors, how are you going to deal with that? I think people broadly understand the principle of an illegal phoenix, which is basically asset stripping by another name. ASIC, ATO have developed some fairly significant data sharing knowledge. And so I'd just be encouraging people to think wisely about how they're going to help their clients through difficult times. And whilst our clients are important, our professional reputation is irreplaceable. So just when you get to these sorts of restructuring type questions, illegal phoenix questions, what do we do? How do we approach them? And most importantly, how do we protect our professional reputations? Somerville was a case by which an advisor was sent to jail for his role in an illegal phoenix activity. It's just not worth it. So please, 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 whilst we want to help our clients, we can't afford to lose sight of our professional reputation. So please take that on board. Happy to take questions, whether it's here and now or whether people want to dial in afterwards. But today was really about developing some building blocks for the next session, which is at the same time next week, which is really about what does a rebuild plan look like? What should it look like? What's the mindset you need to adopt? What are the building blocks? What are the components? And so these are the sorts of things that we're proposing to talk to at next week's session. The reboot plan is going to be really important, and it's going to be important for a few reasons. One, it enables organisations to critically review and commit to what the business is or needs to look like. Sean and Duncan in particular have talked to the attitudes of some of our critical stakeholders, banks, lenders, landlords, workforces, suppliers, tax office. This plan is going to help people crystallise their thoughts and have far more valuable conversations with key stakeholders who you would expect will be asking questions in a far more detailed way in 3 or 6 months' time than they have in the past. And so to have a properly prepared plan, and I'm not talking about a 20-page document, I'm simply talking about a plan which captures the essence of what we're doing and how we're going to do it, that's fit for purpose, whether it's an S or an M or an SME or a family business, just making sure that we've dealt with these sorts of issues so we can convince and educate and take our stakeholders with us. There is the inevitable need to talk to our banks, landlords, trade unions, workforces over the next few months. Let's make sure that we're, as a profession, we're leading the thinking and we're helping our clients get to the point where they can have meaningful conversations based upon well-considered and well-debated plans. So I think that's all we wanted to say for today. We hope it's been... Yes, Duncan. Is it Duncan or Sean?
Sorry. Yeah, it was me. Sean. Look, I just see there has been a question come through, so I was just going to address it if we could.
Sure.
Just briefly, so there's a question here saying, what do we think is going to be in the 23 July announcement? So that is an update that I think Scott Morrison talked about, did a press conference today and talked about the fact that he was going to make some further support measure announcements. My guess is that there will be an extension of things like JobKeeper, or while it may not necessarily be JobKeeper extensions, it will be the same impact in some other form, and it will be targeted towards specific industries that are most impacted. So I would have thought that hotels, pubs, clubs, restaurants, tourism, those sort of things will be the beneficiaries of some sort of additional support, a bit like what we've already seen in relation to the $25,000 grant for construction.
Yep. But I think what it says, we posed a question, what if, on one of our slides earlier. So we might have clients that qualify for that industry or that geography, we don't know. But I think we've only got 3 months of runway until September hits. So we really need to be thinking about what our plan is, what our options are, and what our contingencies are. And so that's really what the purpose of next week's session, building on what we've discussed today, So we hope that you're able to join us in a week's time. So on behalf of Duncan and Sean, thanks for joining the conversation. Very happy to take any questions offline if you wish, and we wish you all the best, and we'll speak with you in a week's time. Thank you, everyone.
Thanks, everyone.